Hello everybody, welcome back to another valuation investing video, and today in this video I'm going to be going over United Healthcare stock, in which why I think this company might have just reached its bottom. And taking a look at United Health stock, we can see in the past year it's down 55%, but over the past 5 days we have seen a nice rebound of 5% in the past 5 days. So this company is making a rebound in the past week, but as we can see in the overall trend of United Health stock, it is down a whopping 55%. Looking at the market cap, this company is a $227 billion company. So if you wanted to buy this entire company, you'd have to pay $227 billion. Also, at this price, we can see that United Health has a pretty hefty dividend at about 3.5%. So right now, if you're a dividend investor, this could be a good time to be buying into United Healthcare. But I would like to add, me personally, I don't really like dividends much, because it's not really tax efficient, and we could get more into that later in the video, but it's better to return to an investor by doing buybacks instead of dividends, but that's another thing to be discussed later in the video. But let's get into United Health's earnings. And taking a look at the earnings and revenue of United Health, we can see the revenue growth over time continues to grow, as we can see here, and the dark orange is the reported revenue and the light orange is the estimated revenue. And as we can see here, in the next upcoming earnings, we still expect an increase in their revenue quarter over quarter. So this company keeps continuing to grow quarter over quarter, and this is a good sign for United Health. But if we take a look at the earnings, this is where it gets bad for United Health, and the reason the stock has been doing very bad. As we can see here, in the 2023s, we can see from 2023 to 2024, we saw increases in earnings per share every single quarter, basically. And then as of this recent quarter, we can see a huge decline in earnings per share of almost 50%, which is why the stock is down about 55%. If you guys didn't know and you're a little bit more new to investing, the main reason the stock goes up and down is because of the earnings per share. If the earnings per share increases, chances are the stock will increase with the earnings per share. But if it decreases, it's going to decrease with the earnings per share. And as we can see here, it is decreasing at about the same rate of almost 50%. And as we can see, analysts still expect even less earnings per share for the next quarter, which is a pretty big red flag to me, that they're expecting even less earnings per share. This is a really low earnings per share for United Health. United Health isn't even expected almost $3 of earnings per share, going from almost $7 of earnings per share, almost $8 right here, all the way down to $3. I think that this drop is warranted in the stock, but honestly, this could be a good time to buy the company, and I think this could be a good time for it to have reached a bottom. Also, taking a look at the revenue growth, we can see that in this recent quarter, they reported a 13% increase over the prior year, reflecting growth across United Healthcare and Optum. So the revenue isn't the problem with United Health, it's the pricing and the premium pricing of their insurance plans. That's the main problem with United Healthcare because of the increased medical costs. Also, they had client retention at Optum RX, and if you didn't know, Optum is basically their technology side of United Healthcare, where they offer analytics and data for other health insurance based companies. And with that being said, their revenue also grew of 18 billion or 13%, and earnings growth of over 200 million or nearly 4%. So as we can see, the earnings is slowing compared to the revenue, which is a red flag and just means the profit margins are decreasing over time. Also, the commitment to reform and performance. This company is trying to undergo a change in their management and trying to get back to what they used to be. And if they could do that, I could see this company really rebounding very well. Taking a look at the lowlights of that earnings report, we can see that the Medicare pricing and cost challenges, like I said, they faced a $6.5 billion increase in medical costs, with $3.6 billion in Medicare and $2.3 billion in the commercial business due to underestimated medical trends. So United Health, if you guys didn't know, had one of the highest profit margins of any healthcare insurance company. They had such high profit margins, but the problem is with that, they had bad pricing coming up to this year. they priced it a little bit underestimated. Like I said, they underestimated their medical trends, which caused their profit margin to decrease and really messed up this company for the year. Also, the Optum Health performance is declining, and Medicaid trend pressures. Medicaid experienced elevated trends, particularly in behavioral health, pharmacy, and home health, leading to anticipated negative margins in 2026. So for UnitedHealth, they're actually expected to lose money in the Medicaid segment. It's probably because of just increased medical costs and also because of the decrease in medical spending from our government in these type of government funded programs, and then also the significant revenue hit from V28 transition, slower recovery path. So they're expected to have a slower recovery than previously expected. Taking a look at the profit margin for UnitedHealth over the past, say, 15 years, we can see it's been pretty much an average over time at about 5%. As we can see, this isn't the recent quarter, but if we looked at the recent quarter was actually all the way down to here. The recent profit margin was at 3%. So this is the lowest profit margin that they have actually almost ever had in the past 15 years. So this is pretty bad for UnitedHealth. And if they don't recover, this could really tear up this company apart. But the thing is, if you are investing in this company, you're really banking on this company to recover their profit margins. Because if you think that they can recover it, say, back to 5%, you can make a lot of money on this company. And the one thing that is making me confident for this rebound and why I think it might have reached a bottom is because look at the increase in buybacks from the company. This was almost the greatest increase in their buybacks since 2020. As of this quarter, they increased their buybacks by a huge margin. They're spending a lot on these buybacks, and this gives us confidence in the future that this company actually thinks that this will go away, these problems, in the next upcoming years. Because if a company buys back shares when the stock price is tanking, that's a really good sign that they're still confident. If you saw this, say they didn't even buy back any shares this quarter, this could be really bad and show us that they might actually think that this makes sense and they might still do worse. But since they're buying back, this is a really good sign that this company thinks they could still outperform in the future and do well. And like I said earlier with the dividends, I'd rather see them maybe reduce the dividend and buy back and do more buybacks. While dividends directly give you that money into your account, that is actually double tax when you think about it, because they use the money that they get from net income. So when they get that net income, they have to pay taxes obviously on the money they make, but then once they pay you the dividends, once it gets into your account, you also have to pay taxes on that dividend. So that's why we say it's double taxed. But for buybacks, they only have to pay taxes on the net income, and once they buy that back, they don't have to pay taxes until they sell. But if they just continue to buy back, they don't have to spend extra money on that. They don't have to spend extra money on taxes. So that's why I think buybacks are a little bit better than dividends. And also, if they buy back and in the future the company starts doing really well, this will even help the stock even more since they own more of their company. So that's why I personally like buybacks over dividends. But there's nothing necessarily wrong with dividends, but nonetheless, I think right now they're still probably going to keep this dividend there, and I think the dividend's still pretty safe at this area. But nonetheless, I still want to see them buying back a little bit more. And taking a look at what some recent news is happening with UnitedHealth, we can see the nation's largest provider of Medicare Advantage plans, which is UnitedHealth, is dropping certain plans that cover over 600,000 people. Their plans are being dropped are primarily those in which seniors have more choices on healthcare providers, and this decision comes as UnitedHealthcare faces a federal civil fraud investigation into its Medicare Advantage plans. However, the decision to drop some plans come as UnitedHealth faces a civil fraud investigation, like I said. However, the company says it still has full confidence in its practices for this process, and they're fully up to cooperating with the Department of Justice. So that does show us a green flag why I think this still could be a good rebounding spot and why UnitedHealth could be at a bottom, because they're coming out and saying that they have full confidence that they didn't do anything wrong. And if you don't understand what I'm saying, basically the DOJ is investigating them on their Medicare Advantage plans, where they basically are kind of accusing them of investigating them that they would over exaggerate their patients' say illnesses, and they would get more money from the Medicare Advantage program because of these over exaggerations. But they said they have full confidence that they aren't doing that, so that could be a green flag. But taking a look at my 7-step stock analysis, this gives us the financial health of United Healthcare. Previously, this was actually 6 out of the 7 key metrics, but now it's only 5 as a result of that recent earnings per share decrease just last quarter. As we can see, it's only increased 1% over the past 5 years. So that decrease in earnings per share has hurt the financial health of United Health. I still think it's not a huge worry as of right now, as long as they can rebound. And the PE ratio is still right around 11 or 10, but the forward PE ratio obviously has increased. So if we see an increase in forward PE ratio, especially compared to the trailing PE ratio, that means analysts expect less earnings per share in the future. So that is the big problem with United Health. Analysts expect them to decrease in the upcoming year. But if we can see in the future, if we look out into the future, I think United Health could still continue to grow and get back to normal, and that's why I think United Health could be a good time to be buying. Also, the revenue growth is still growing at a good rate at 11%, and last quarter, year over year, it actually grew 13%. They're buying back shares at about 1%. The debt to equity ratio is a little bit high, but the balance sheet still isn't bad. And the expected EPS growth rate is 9%, so it's still pretty decent for United Health. Even though it's 5 out of 7 now, it used to be 6 out of 7, it's still looking pretty good for the financial health. But now taking a look at my intrinsic value calculator for United Health, we can see right here I have to do future assumptions of the annual revenue growth rate. Taking a look at United Health's growth rate over the past 5 years, we can see that they've continued to grow at basically double digits of almost 12%. And like I said, they were growing at 13% just in the past quarter. So with that being said, I think for the annual revenue growth rate on the bear case, I'm actually going to be a little bit more bullish, even though it's a bear case. I think they can continue to grow at 6%. Once again, this is a bear case, so this is going to be on the lower side, and it still probably won't happen, but it's good to make sure that you're doing a bear case. Also, for the base case, let's say 9%, and then for the bullish case, say 12%. If they could grow 12%, which basically they've been doing, that could be really good for this company and could be a good sign to buy. But here's the hardest part with United Health, the future profit margin. As I said with the future profit margin, we can see it has been all over the place. The average has been about 5% over the past 10 years, but right now, even though this hasn't updated, it's technically at 3% right now. So with that being said, we have to think in the next 5 years, do we think that they can get back up to that percentage? So with that being said, going back to the intrinsic value calculator, can they get back to that 5% profit margin? I honestly couldn't tell you. I don't know. Let's say for the bear case, they remain at 3%, which I think is pretty unlikely in the next 5 years, but let's just say that's the case. Then the base case, let's put 4.5%, which I think will happen in the next 5 years. And now for the bullish case, let's say they get back to 6%, which I probably don't think is going to happen, but honestly, it could, because that is where they were at some points in history, but this is the bull case, so it's a little less likely to happen, and the base case is the main thing that I think will happen. Now, taking a look at the PE ratio, we can see the PE ratio over the past 5 years was basically 15 all the way to 30. But as a result of this huge increase in the stock price and also their earnings, we can see it's down all the way to about 11 PE ratio. And for the bear case, if a company is growing at 6%, I think for the bear case, we could put a 12 PE ratio. For the base case, I think a 15 PE ratio. And for the bullish case, I think an 18 PE ratio is fair for United Health. Now for the shares outstanding, looking at the shares outstanding over the past 5 years, they started to increase these buybacks at nearly 1% and almost 2%. So honestly, I think they're going to start buying back even more next quarter because of the huge decrease in stock price. So for the bear case, let's say they only buy back at 0.5%. For the base case, say they buy back at 1%, and for the bullish case, say they buy back at 1.5%. And with that being said, for the base case, I get a 14.5% return on your investment, which I think will happen. For the bear case, I think you could get a negative return of negative 2%, but for the bullish case, you could get 30% return, which honestly isn't too far out of the realm of possibility. But honestly, I think that profit margin is too high, but say they just return to that average that they've had over the past 5 years, I think you can make 25% if they continue to grow at 12% revenue growth. And keep in mind, they've been growing at 13% revenue growth in the past quarter, year over year. So this is definitely possible in the future. So with that being said, I think UnitedHealth looks like a pretty interesting company. Me personally, I have not bought any position in this company just yet, but I'm very intrigued to. And right now, I think honestly, UnitedHealth might have made a bottom as of recently. And with that being said, thank you guys for watching this video on UnitedHealth. Please subscribe, hit the like button, comment down below, and thank you guys for watching. See ya.